I told you about. The bank then sends the money to the closing agent. Okay, but conceptually, buyer, borrower has borrowed the money and given him a note mortgage to the bank, and the bank has put some money in the put $75,000 in the pot. Okay, now step number 3. It's not here. They're going to sign a HUD-1 closing statement. We're going to look at one in a minute. Buyer and seller are going to have to go through and sign a closing statement. That's all the debits and credits and charges, and prorations and adjustments and all this crud to figure out how much money the buyer had to bring and how much money Bill's going to walk away with. That's all on a closing statement. You got to have one. You got to have one because otherwise nobody knows who owes who what. It ain't as simple as 75-25 by a long shot. They sign a closing statement to figure out how much money is going to pass. Both ways. In and out. All right. Step number 4 is the bottom arrow that says deed. Then the seller deeds the property to the buyer. Okay? But he doesn't really hand the deed to the buyer. He hands it to the closing agent because somebody's got to record it, right? Got to get recorded. So he gives that to the closing agent. Really goes to the buyer, but then the closing agent gets it. Step number 5. Money then comes from the buyer to the seller. But there are really 2 pieces of money coming to the seller, right? There's the $75,000 that he got from the bank going to Bill, and there's the $25,000 he's put in the pot. That's going to Bill too. So there are 2 pieces of money, and really they both come from the closing agent, because the buyer's giving his money to the closing agent too, and the closing agent is going to pay the seller. But it's 2 sources of money: new loan money and buyer's money. All right. Number 6, upper left there, is Bill's existing mortgage. Bill has a mortgage on the house right now for $60,000. Right now. Got to get paid off. This bank wants a first mortgage. So we got to get rid of Bill's $60,000 mortgage. So step number 6 is theoretically the seller paying off his $60,000 mortgage. But who pays it? The closing agent pays it, because he had all the money anyway. So the closing agent sends this bank $60,000. And what that really means is Bill's going to get 40. That's cool. Of the 100 that got put in the pot, 60 is going to pay off Bill's mortgage. Bill's going to get 40. That's cool. Still $100,000 sale price. And the last step, so that was number 6, money heading up to the bank, up to the seller's lending institution. That means the old bank. And the last step is this cancellation of mortgage. We call that a satisfaction of mortgage. The bank that got paid off signs a document called a satisfaction of mortgage, sends it to the closing agent. Closing agent records it, and then this bank is gone. And this bank no longer has a lien on the property. The only person that's got a lien is this bank. It's got a $75,000 mortgage. And the closing is over. Bill's gotten his $40,000 minus 6% to the broker. Bank's paid off. He's put in his 25 plus some cost. Bank's put in 75. Title company then has paid everybody. Title company's got all the documents. So title company goes and records the deed to B. The next instrument they record is the mortgage from B to his bank for $75,000. And then a couple weeks later, when they get in the mail the satisfaction from the paid off bank, they record the satisfaction that killed the $60,000 mortgage. And then, at the very end of all that, then they issue that title insurance policy to B. B, you own the house, free and clear. Just you. Your title's good. Mortgagee title policy to bank. Bank, you got the first lien on the house for $75,000. And it's over. And that's a closing. Any questions? That's what goes on at a closing. Now, I want to talk about one or two more concepts. Then we're going to go through a closing statement real fast. Unfortunately, real fast. And see where all the numbers came from in this closing. There's one law we have to talk about. It's called RESPA, R-E-S-P-A, Real Estate Settlement Procedures Act. Remember we talked about most real estate law is local state law? Not this. This is the feds. Federal, Congress, Real Estate Settlement Procedures Act, federal law requiring lending institutions to disclose certain information to their borrowers, to purchasers. This applies to 1 to 4 family units, residential, where the lender is a federally insured lender. In other words, a bank, an FDIC insured bank, making a loan on a single family house, RESPA applies, or a duplex, or a triplex. And the lender is a federally insured lender, and it's a new loan, okay? All right, now, so the law regulates all kinds of activities between the bank and the borrower and all the closing agents and everybody involved in the transaction. The first thing is the bank has to give a settlement cost booklet to the buyer within 3 days after you apply. Everybody takes it. This is cute, about this big, throws it right in the trash. But they got to give it to them. Nobody reads it. But that's first. Second thing is, at the time of the application, the lender has to give the buyer a good faith, the borrower, customer, a good faith estimate of what all the closing costs are going to be. It's a guess. But it's eye-opening when they see they're going to pay a 1% fee of $750 and an appraisal fee and a title fee and but give them some idea where all the fees are going to be in the loan. Okay. Then they are supposed to, there's going to be this closing statement we talked about, and the bank is supposed to make sure that the day before the closing the buyer gets it and gets to review it. It has never happened in the history of the world that the buyer gets it in advance. The buyer is lucky if he gets it 30 seconds in advance of the closing. Usually you get to the closing and they're still working on it. There's no penalty in the law for not giving it a day in advance. So it doesn't happen, but they got to try. Now, what the law does though, and I'm going to show you one in a minute. And it's interesting when this all started in the late 70s. I think in the late 70s. 79. Congress passed RESPA to try to say we want to make residential real estate lending throughout the country more uniform. So that as people travel from state to state, stuff will look more alike. So they came up with this closing statement called the HUD-1, HUD-1. And it's a closing statement between the seller and the buyer, and it also sets forth all the lender's costs to try to come up with all of those numbers that I told you about of how much does the buyer really owe and how much does Bill really get, and all of the costs that it took to get there. But what the federal government said was, and we got a form for this, and we're telling you everywhere, all over the country, you all have to use it. And everybody went ballistic. And we all said, hell no, you can't tell us what to do, and what are you guys going to Washington about Florida real estate? But ultimately, over the years, we all got used to it. And now it's what you have in closing, what you have in residential closing. You have in some commercial closings. But just about every residential closing uses the HUD-1 closing statement. That's one of the most lasting effects of RESPA, is it gave us the HUD-1 closing statement. The other thing that RESPA did is it prohibited what it calls a bunch of abusive practices. And this worked, because they started putting people in jail. They said no more kickbacks on loans, no more paying referral fees. In other words, loan officers were getting paid fees by brokers for making deals, for bringing deals to them, referral fees. Banks were requiring you to get your insurance from a certain insurance agency, and the insurance agency would kick back a portion of the premium back to the bank or back to the loan officer. All these illegal fees and kickbacks being paid back and forth. Congress decided that drives up the cost of buying a house, because this all gets added in, and it prohibited all of it and made it criminal and started putting people in jail. It worked. So that's part successful. Now, we're going to go look at a HUD-1 in 2 seconds, and let me just see, there was one more point, and we've already covered it. After the closing, deed is recorded, mortgage is recorded, title insurance is issued, deal is over. So let's go look at the HUD-1 that I gave you, and we'll get as far through this as we can. And this is what it looks like, the form that the government required everybody to use. Upper left, the HUD-1 settlement statement. You see in the middle HUD. It's HUD that regulates all this stuff. Now, it starts out here naming the parties. They call them the name of the borrower. Well, that's the buyer, of course. But it's the borrower because there's always going to be a borrower, because it's a federally related mortgage loan that got us into this thing. However, we use it in a lot of deals now, even if there's not one, because everybody's finally gotten used to it. So you got a name of a borrower. You got the name of the seller. And let me go ahead and tell you now, this is not a residential deal. I gave you a sample from a commercial deal, so you can see it's the HUD-1 closing statement, but we even use it in commercial deals now. As you see, your buyer and your seller are both LLCs. This is pretty commercial stuff. In fact, you see the property location? This happens to be an 11-unit apartment building in Coral Springs. So this sure as hell is not a RESPA transaction of a 1 to 4 single-family residence, you know. 11-unit apartment building in Coral Springs, it was going to be converted to condo. There's a bank. There's a settlement agent we talked about, the Walton Law Firm. That's the closing agent. That's the one who's going to get all the money and do all the recording, all the documents. And of course, there's a date. Now, stop right there. In order to make this statement work, you now have to go to page 2. Because what you see here, we're now going into something called the summary of the transaction on page 1, where you can't get to the summary until you got all the other stuff. So now we go to page 2, which is all of the costs involved in the transaction. And there were many. Let's just go through them real quickly and see what they are, to give you the flavor of the types of costs that could be incurred in a deal. The first section is the broker's commission. There are 2 brokers. They're splitting the commission. The commission in this deal is $92,500. Now, you see 2 columns here. Paid from seller's funds on the right, going down, top to bottom. And next to it, paid from borrower's funds, top to bottom. These are both way over in the right-hand column. So going down the left, we're going to tell you what it is. And then on the right, we're going to tell you what it costs and who's paying. So stuff the seller's paying is in the right-hand column, stuff the buyer's paying is in the left. So going down, let's go down now from top to bottom and say who's paying what. Seller's paying the brokers $92,500. The next is a group of costs created by getting a new loan. The bank is making the $75,000 loan here. It's got all the following charges. A 1% commitment fee to the bank, a 0.25% commitment fee to a broker, a tax service fee, a flood determination fee, attorney's fees to the bank's lender, costs to the bank's lender, and an appraisal fee to the bank. All of those costs are paid by the buyer because, of course, the buyer pays the cost of his own new loan. No reason the seller should pay those, and the contract says that. Buyer pays all those costs. Next section would have been if they were collecting, like line 903 and 904, if the bank were collecting the insurance premium to pay the first year's policy on these premium on these policies, but they didn't. What that means is the borrower had already gone out and paid for a first year's insurance because the bank wouldn't be closing unless that insurance was in effect. So simply in section 903 and 4, the bank's not collecting it, but buyer's already paid that on the outside, you're just not seeing it. The next section is escrows. And we don't have time to get into escrows, but escrows are where the bank collects stuff every month to pay once a year for the borrower, like taxes and insurance on the future premium. An insurance policy is going to come due again in a year. Bank wants to have the premium, so they collect it monthly, they collect the taxes monthly. In these cases, they didn't collect any of that. But interestingly, they collected a renovations reserve, which means they're going to hold back 25.6, is that what that is, or 25,000, one or the other of their loan proceeds, to be used to renovate the property because it was going to be converted to condo. And they collected an interest reserve. This is an incredible racket where the bank holds back this money and then pays itself every month. They charge you interest on the whole thing, then they keep back 145,000 and they use it to pay themselves every month while they're charging interest on this. That's what it is. Now, there's some title charges. These are some of the things we just talked about all the searching and examining title. These are the things, Andre, that somebody is charging you to do it for you because you can't do it yourself. Okay, the closing agent is charging $495 for sitting at the table and pushing all the papers around. That abstract or title search, that's the original search that somebody has to examine. The cost of that is $295, and seller provides that. Now, the title company, the law firm, they examine the title, so they get $475 on line 1103 for title exam. Two different law firms here got attorney's fees for something or the other for the buyer. I don't know what for, but these are more attorney's fees charged by a couple of more law firms to the buyer. Line 1106, the Walton firm formed the LLC, and the Walton law firm also charged some attorney's fees to the buyer too. The cost of the title insurance policy itself, that one-time title premium for the title policy, was $7,537.50. That's set by the insurance commissioner. That price is set by law, based on the purchase price. Over on the left, that provided title coverage on line 1110 to the owner in the amount of his purchase price, which you're going to see is $1,975,000. And it also provided coverage to the lender on its mortgagee policy I told you about for its $1,808,000. That's the amount it's loaning. And then there's some miscellaneous endorsements to the policy, no big deal. There's some recording fees now to record these documents. For example, line 1201, we're going to record the deed. I told you it was $10 and then $850. Well, it's a two-page deed. Buyer pays $18.50 to record the deed. Big fat long mortgage, buyer pays $171.50 to record the mortgage. There's some releases, they're going to be paid for by the seller. That means like releases for paying off these claims and mortgages and things like this when they get recorded. Seller pays for recording those. Bigger numbers are, there's a state tax of 2 mills on the mortgage called an intangible tax. That's $3,600 state tax on the mortgage. There's also a documentary stamp tax on the mortgage, and that's $6,329. So the cost of recording that mortgage, state taxes, is about 10 grand. Those two together, taxes alone. And on line 1203, the state charges a stamp tax on the deed. That's 0.7%, and the seller pays that. That's $13,825. So the state did pretty well here. The state got about 20 grand in recording fees for this transaction. A couple more miscellaneous recording fees. Paying for the survey, $1,650, cheap compared to the rest of this crud. Courier fees, stupid little, file this, deliver that, bump. There's something on the next page which is junk, paying some landscaper $600. But when you boil it all down, we got two totals at the bottom here. We got the total settlement charges to the borrower of $240,000. Now that sounds stupid, but 145 was that interest reserve, and 25 was that renovations reserve. So really the costs are more like, $70,000, cost of the loan to the buyer. Cost of the transaction and the loan. And the seller's costs are $107,000. And hell, most of that was the broker at $92,500. And the recording fees of the doc stamp. So we've got the total closing cost to both parties here now. Now we go back to page 1. And we get into this, let's go down the left side real fast. Summary of the buyer's transaction. 101, the buyer owes the purchase price, $1,975,000. He hadn't paid that yet. 103, he owes all the settlement charges we just saw of $240,000. There was some other Mickey Mouse thing going on here, 21, some credit that he owes. There was some rent on a vacant unit, not worth talking about, we're out of time. The total on line 120 that the buyer owes is $2,218,000. Okay? Grand total, buyer owes $2,218,000. Here's what he's paid. He's paid $70,000 on line 201. He signed a new note and mortgage for $1,008,000. Now, incredibly here, the seller gives him a contribution of $362,000 towards his closing costs. Not even worth discussing, it's so absurd. And a credit on line 209 for the security deposits. Seller has a tenant security deposit, buyer is buying it, needs to get credit, because someday the buyer is going to have to refund those security deposits. So, in addition, we're going to prorate the taxes, and we're just out of time, we're going to explain this. We're going to prorate the taxes, and we're going to prorate the March rent between buyer and seller on these two lines, on 211 and 213. Those are actually turn out to be credits to the buyer. But when you grand total it all up, line 220, total paid by the borrower, including all of his credits, are $2,257,000. So remarkably in this deal, and that's why this one ended up in the bankruptcy court in a few months. Remarkably in this deal, line 301, the gross amount due from the borrower was $2,218,000. That was up on line 120, right? And the total of all the buyer's credits on line 220 were $2,257,000. The buyer gets $38,000 back at the closing. Stupid deal. And I could explain all the whys if we had time. Seller, upper right, line 401. Seller is entitled to a purchase price. He's entitled to some of these other he's getting some of these other contributions. No big deal. Total amount due the seller is a few more nickels. $1,978,000 on line 420 is the gross amount due the seller. Now, however, he's already received $70,000 deposit. His settlement charges were $102,000. He's got a first mortgage to pay off of $278,000. He agreed to give this crazy contribution to the buyer of $362,000. And he has to give those security deposits back to the buyer. These lines match up with each other. We have to adjust the taxes, and we adjust the rent, and therefore, line 520, total reductions in the amount due the seller are what, $834, is that what this is? $834,000. So the gross amount due the seller above was $1,978,000. The deductions in the amount due seller were $834,000. Net cash to seller. Seller walks out of here with $1,143,000, and he already got the $70,000 deposit. And that's the deal. This is a HUD-1 closing statement. If you close a house, this is what will be used. It was used in this commercial deal because I want to do commercial deals with you guys because that's what I want us to focus on. But it can be used in any closing. It's required to be used in the residential. The closing agent chose to use it in this. And the reason they do now is all the closing agents have it on computer. And it's the only form they have on computer anymore. Now, I don't mean just, computers calculate all this crap, you know. You tell them what the settlement date is, and they prorate the taxes, and they prorate the rents, and they prorate this, and all this crap. It all comes together. But normally, this line 303, normally that's the telling the buyer how much money to bring to the closing. Except this one was backwards, where he got money back. And seller's going to walk out of there with $1,143,000. Now remember, buyer's money went into the closing agent, lender's money went into the closing agent. So it's the closing agent who's going to wire to the seller the $1,143,000. A combination of the buyer's money and the lender's money going up to the seller. But $278,000 of that money had to be used to pay off the seller's mortgage, and to pay the broker, and to pay, pay all the other baloney you saw on the next page. And that's how we end up with these adjusted numbers, ups and downs and all arounds, and you end up, after prorating taxes and prorating rents and all the closing costs and everything, that's how you come up with a net. Now, we're done. I want to make one comment, but do you have any comments on the closing statement? I mean, I know we went through it too fast. However, in most closings, you won't get that long an explanation. You'll get told, you get $1,143,000 signed. Because they got 12 people out there waiting for the next closing. So you've got to count on somebody that understands this to look it over for you to make sure it's correct, unless you think you can do it in 30 seconds. And that's how deals get closed. Buyers more often have lawyers. Sellers at least think they know how to do math, and they don't need a lawyer, and they can at least follow this. And you kind of can. You've done a few of these, you can. There's not a lot of rocket science and add and subtract and prorate, you know. And for a seller, there's not a hell of a lot else going on. Buyer's got all the worries here. Inspecting the property, inspecting the title, making sure everything's cool. Seller just wants to hand over a deed, give me some money. So sellers are less often represented. I want to look for 2 seconds at the changing landscape paragraph on page 474, and I want to read this real fast, and we're done. And I think I told you this changing landscape thing is good in a lot of cases, and it is. The second paragraph of this. In contrast, today, the conventional closing often occurs 30, 60, 90 or so more days after the parties have signed the contract. Moreover, it involves a number of persons beyond the buyer and the seller and mounds of paperwork. Buyers and sellers usually sit in some anxiety as paper shuffles past them and they are obliged to sign document after document. Although each document is clearly titled, it probably comes with a bit of an oral explanation. Not even the attorneys representing the parties have read all these documents. Each year, new forms are added to the pile. Federal mortgage regulations, state law, lenders' policies continue to enlarge the heap of paper. There has been an end to the paper mill, and there has to be an end to the paper mill, and there has to be a better way to accomplish the closing. Although federal law requires that this real estate settlement closing statement that I showed you here is given to the purchaser 24 hours before the closing, this rarely happens. Thus, the parties and their attorneys are rushed to closing and pressured to sign the documents as the settlement clerk instructs, oftentimes finding out too late that mistakes were made. Perfect. This is very well said, and this is exactly how deals close. And it is what it is. Now, this says, is there a better way? Yeah, there probably is. But this is a great explanation of what it's like. And although it's taken you 90 days to get there, part of the problem is the bank hasn't given its numbers to the closing agent until 15 minutes before the closing. And there's not a damn thing you can do with it. And they can't work out these numbers until they have them. And that whole list of all the closing costs from the bank, they got those 15 minutes ago. And plugged them into the computer, and it finally spit out the closing statement to see how much it is. And the buyer's waiting at the bank to tell his bank how much to wire to the closing agent. And then he hauls ass over the closing and signs it. That's how it happens. you can slow down closings in commercial deals because often you don't have new banks, and often if you do, it's a commercial loan. They don't have them. Commercial lenders will give you their figures in advance. They know what they're doing. They're sophisticated people. Residential closing. I mean, I would much rather do this commercial deal than put up with one this size and put up with a bank trying to do a residential loan. They'll just make you crazy. End of speech. That's it. Any questions? That's how we do a closing.
You sent us an addendum?
Yeah, that's correct. As I told you, there's a stupid $600 landscaping charge on an addendum. If the point is, there were so many damn charges in this closing, they ran out of space and they didn't have a line. That's so. You'll see at the bottom of the closing statement, it says, one more charge, see addendum. At the bottom of page 2, it said, one out of space, one more line, see addendum. And they had to put it over there, they ran out of space. That's all it is.
So this buyer basically didn't put any cash down.
I'm sorry?
The buyer didn't put any cash down because the seller gave him the
Well,
it looks
yes.
like the seller basically gives them the what do you call it?
seller
down
discounted
payment,
the deal $300 and some thousand.
which would pay for a down payment.
Yeah.
Because basically the loan it covers up
The
to
loan covered everybody and their brother, including a bunch of money into the reserve.
right.
And the units didn't sell as a converted condo, and the bank ended up owning an apartment building worth about $1.3 million.
Nice.
That they theoretically had $1.8 million in, and that's really about what it was worth. Really, the seller was selling for $1.9 million, but he gave the buyer a credit of $362. So right away we're down to what, $1.6 million, $1.5 million is what it was probably really worth. But the lender loaned a real $1.8 million. But they held back 145. So I mean the number.
That's on the lender.
I'm sorry?
The lender's due diligence was not.
But this
Because realistically, the buyer and the
This
seller
was,
made that.
what was this? I forgot. 2006, 2007,
Yeah.
just before the bubble burst,
Okay.
where lenders couldn't wait to loan you 95%
Jesus.
because everything was going up so fast, and then poof, all of a sudden this thing is only worth $1 million. What are we going to do now? You know, of course, the buyer's going to quit paying because it ain't worth it anymore,
Right.
and the lender's going to foreclose and take it back, and then he can only sell it for $900, and the tenants have moved out, and you know, it's a nightmare. But that was the heyday. That's when things were good. But what that really was a building that was worth $1.6 million, and the brokers talked the parties into, let's write it up for $1.9 million, have the seller give the buyer a credit for $360. And then we can go to the lender and say, it's $1.9 million, how'd you like to loan $1.8 million? And the lender says, cool. Now, the seller hasn't done anything wrong as long as all that's disclosed on the closing statement.
But
If that
what
weren't
was the
disclosed,
appraisal on that?
I'm sorry?
What was the appraisal on that? Because that's the person who's supposed
Oh,
to be.
they got an appraisal. I guarantee you they have an appraisal for $1.8 million.
$1.9 million?
Yeah, $1.8 million, yeah.
That's-
No, I take it back, I apologize. They have an appraisal for the purchase price.
So,
They don't just have an appraisal for their loan.
So then
They have an
who gets the
appraisal,
suit?
some appraisers said that this is worth $1.9
So
million.
who gets the
Did you
suit
see who the
appraiser?
appraiser was? Did you see who the appraiser was?
It was
the
the
bank.
same, yeah.
It was the bank, in-house.
yeah.
They didn't even hire an outside. No outside guy would touch this with a 10-foot pole. But they paid themselves an appraisal fee in-house of what, 0.5% or something,
Right.
so that they could have some guy over here say, it looks like $1.975 to me, you know. Because what they probably did was they said it's 11 units,
Yeah.
let's make them condo, and we can sell them for $200,000 apiece. So it'll probably sell for $2 million too. Once we convert it to condo
Well, in
and sell 11
2005
units at 200 each.
In
You know.
2005, it looked like.
Looks good on paper,
Yeah.
you know, it just didn't work. And it might have. If the economy had kept cooking and those units were then worth 2.25, this might have all worked, but it all blew up. My client was a seller. I asked him if I could use his closing statement as an example. He said, sure, I don't give a damn, you know. What was important to him and to us was that the sales contract reflect the $1.975 million, and the sales contract right in its front reflect this credit, and that it be on the closing statement, so the lender couldn't say, you guys snookered me.
Right. Yeah.
We told them.
It's right
Here's
there.
the contract, here's the closing statement, you're an idiot, you're loaning $1.8 million on a $1.6 million deal.
Yeah.
They said, okay, sounds good to me. So, you know,
That's awesome.
and the seller came out well. I mean, he got what, he got like $1.2 million, and he got his $300,000 loan paid off, so he got his $1.5 million. It was really, I mean, it was an okay deal for him. It just all came from the lender. The buyer had put 70,000 in. Remember, he had put a 70,000
But he also got
so when he got the 38 back, well, he got 38 of it back. So he has 32 in the pot.
He put 30,000 in to get
It got a $1.9 million. Yeah, no, wait, he got $1.6 million for 30,000. Guess it was worth $1.6 million. Yeah.
I got.
Is this a great country or what?
I was like,
Yeah.
so let me go buy
Take that all day long, right?
$1.9 million. Heck,
Yeah,
$1.6 million.
listen, you guys come up with deals like that, I want you to call me, I want to get in, you know?
That's
All right.
a deal of the century.
Yeah.
I'm sure that buyer.
I wish we had time to talk. There are a lot of laughs in there that I could talk you through when we had time to talk.
Because even then, even with the buyer foreclosing, I'm sure he somehow made out in that deal.
Even with what, I'm sorry?
Even with the buyer foreclosing, I'm sure he.
The lender foreclosed.